Welcome to tonight. We're looking forward to sharing some time with you tonight and talking about unlocking potential and helping you get set up to buy your investment home, whether it's your first one or you buying multiple ones. We're going to be talking tonight about buying that property for you. Now, tonight is not really necessarily talking about rental property, but it is talking about how real estate, when it's done wisely, can create cash flow for you and can create options and independence and make things a whole lot better for your future choices. I'll share a story real quick about my first tenant. My first tenants moved into a home that I bought the home, and it was a fantastic opportunity for me. I found this fantastic rental only to have the ice line break on the rental. And all of a sudden, I was looking at $50,000 worth of losses because I ended up with 2 inches of water on the entire first floor. It broke on a Thursday night. We didn't catch it until Sunday morning. Monday is when the tenants were moving in, and I had $50,000 worth of water damage in less than 3 days. So that was the first mistake because I didn't necessarily know what I was getting into. Now, more than that, then I accepted, man, I got this gift from heaven on a tenant who wanted to give me 30% more rent than what I could have gotten on the open market. And I went ahead and did it. It was 30% more rent, and it was to college kids. And I ended up spending some money trying to fix everything that they did. I had no idea that you could get beer on the ceiling. Had no idea that that was even possible. But they found a way to do it, and it cost me $21,000 over the next 3 years because I had 3 years of college kids in there, and it was really quite the experience. And simply, it's one of those experiences that helps me understand that investing is not just about buying a house. It's not just about collecting rent. There's a whole lot more to this whole thing of buying your first real estate investment or your second investment. And so the real question you need to be asking as you're getting started with one of these things is, not what house should I buy? I mean, that's fairly easy. Houses are easy to find, but you need to really ask something different. You need to start by asking a question that goes like this: what would an investment model look like, and what am I prepared to operate successfully? That's the real question you need to be asking when it comes to buying your first rental. Because before we discuss the properties, you need to discuss what the life is that you're planning on looking at. And we don't know what success looks like, but we can know whether it's a good investment or whether it's not a good investment. But a lot of it's going to come down to the model. And you're going to have to figure out how you want to get this model set up, because it's not just about the capital. It's going to be a lot about the customer too. It's going to be a lot about the property condition. You're going to have to get set up with contracts. You're going to have to understand vendors. So you're not just buying a house, you're starting a small business. And the property is the product, and the tenant is the consumer. Rent is the revenue, repairs are your expenses, and you really need to make sure that you know how to create an operating system that is going to be designed and set up to make sure that you're serving your clients, but also that you're making a profit. You literally are starting a small business. And so really what we want to do tonight is we want to spend a little bit of time understanding what that business looks like so that we can get you set up with this. And many of you are here because you've worked hard, you've saved money, and you're like, there's got to be a better way to use this, but you don't want to take a gamble. And I am going to be sharing with you that taking a gamble is not wise. You need to go in understanding what your business model is going to be before you take action, because clarity in this case is extremely important. And strategy is extremely important too, because you might be able to survive 2 inches of water in the bottom of your house. Insurance might take care of that. But can you solve $21,000 worth of repairs as well? And that's a really big question. What if the HVAC system fails? That actually happened to me on the rental this last year. I had to replace the heat pump. What if rent comes in lower than expected? What if taxes and insurance increase, which is happening all the time? What happens if I lose my job and I'm not able to keep up with it? These are all big pieces that you have to have and you have to be talking about as you're going through these. These models that I'm going to be sharing tonight are not models that I built in a vacuum. These are models that I have learned through reading, number one. Number two, through application. And number three, the hardest university of them all, the University of Hard Knocks. Okay, so I'm going to be sharing some of this information for you so that you can kind of think through how you want to get this set up long term. And your flood story doesn't need to be the same as mine. Your tenant story doesn't need to be the same as mine. But you really need to be asking the question, can I continue owning this property if something goes wrong? And that's a big question. So tonight, what we're going to be talking about is we're going to be going through these different models that you're going to be seeing right here. We're going to be talking very explicitly about a client model. We're going to be talking about what the opportunity cost is of getting set up, who you're going to be serving in the client model. We're going to be talking about the financial model. There's no single best model for renting out a model, but it's understanding what it is that you are willing to do in order to get set up for success with this, for the property that you're going to be serving and the investment that you're going to be doing and how you're going to be operating this is going to be extremely important. And so this is going to be extremely important for us to have this discussion because the goal is not to just put most of the money down and then try to move into the house. Your goal is to make sure that you're maximizing your return, putting the right amount of money down, but not putting yourself in a position where you physically cannot protect your family because you've created a draw on your liquidity that is funding this investment model. So, but we also want to talk about the cost of waiting. Maybe indecision does have a cost as well. So your financial model is going to play a big model in that. And then, making sure that you have a team behind it so that you can help get set up for the changes that are happening with that as well. Now, the team behind the investment plays a big role with this as well. And so understanding how to get set up, make sure that you have a strategy in place, a team in place to help you find, help you select, and then you have to do the hard work, which is understanding the model that you're building when it comes through this. And then you have to decide how you want to manage it after the case. And most people really start backwards. They start talking about which house should I buy. And while the house is important, I actually think that's the wrong question. Because when you're buying a rental property and you're starting a small business like this and the property is an asset, you really need to make sure that you create an operating system that is going to sustain you for the long term with this. And so starting with a house is really the wrong question. You really need to be starting with who you're going to be talking to when it comes to the tenant themselves and who you want to put into this house. And so when it comes to selecting the right tenant and making sure that you're getting set up for the lease and reserves and other plans, oops, I moved a little fast. This is going to play a massive role in how you do it. And here's the piece why you need to think through this. There's a lot of investments out there. You can get into the stock market. You can buy a small business. You can be an angel investor. You can get into stocks. You can get into markets. You can get into bonds, and you can get into real estate. There's a lot of different places. Annuities are a good place as well. And these are all parts and pieces of what you need to be looking at. You can put into 401ks. There's all places that you can do this with. The big piece that you need to understand is that real estate does function a little bit like in a stock or a 401k. Is you're going to have the asset, you're going to put the money into the asset. It's going to grow in value over time, but it's not a passive growth. You have to have the active side of this because you're going to be receiving rent. And that rent plays a big role in how you're going to be able to function and make sure that you're operating your business correctly. And then afterwards, you're going to be able to depreciate and you're going to be able to take a taxable advantage in it. And then the cash flow is what's remaining after that. Most people think that if I'm charging them $2,500 in rent and I'm only paying $1,700 in mortgage, that, yeah, I'm making $800 a month. And that sounds fantastic, but you really need to take into consideration other pieces. Now, there are some significant pieces that we can get set up when it comes to helping you understand the math behind it, understanding the taxable advantage, but you still have to have enough reserves and liquidity for the what ifs. Okay. So for example, like that heat pump that I had to replace just this last year, if I had created the reserves through managing the rental appropriately, I would have gotten to the point where I would have been completely set up for disaster and had to figure out where I was in it. So I was spending that $800 every single month, month after month. I was going to find out that I was in trouble sooner rather than later because I hadn't created enough of a cushion to help protect my investment. So those are parts and pieces that we're going to be talking about. Now, the first thing that we're going to be talking about is before we pick the house, we really need to understand, since we're going into business, who is the client that we're going to be serving? Because every tenant model has a trade-off. There is no risk-free version of getting into real estate investing. But if we calculate the risk, we can help mitigate the risk, and we can create a situation to where as we actively manage the real estate, that it can turn into cash flow. Because the real goal is never the extra house. It's about the life that gives us once we've used it. It's not about the mortgage. It's about the life after. That's what we're looking for. How does this help us with a life after? And sitting in and identifying that client model is going to help us visualize the client that you're willing to work with as a tenant. And there's several different models that can work depending on your resources and your willingness to be involved in the process. But you need to make sure that your strategy works, because wealth building doesn't happen in a vacuum, and you need peace of mind as you're going through this. It's not risk-free, it's not responsibility-free, but there are some things that you can do to make sure that you're strategically setting yourself up to win when it comes to buying investments. And the more you do it, the more likely you are to win from it, and make sure that your risk is a calculated decision that's providing you with some really good outcomes. And I know you want to pick the house, and I think that's a great thing. That's the fun part, right? You get to pick out the house. But the really big piece is that what you want to do is you want to make sure that your strategy works, so that when you go into, in my case, my strategy is I'm looking to buy rentals so that when I get into retirement, number one, I have something to do, but then number two, it provides me with an active source of income in the retirement phase of my life. That's exactly what I'm looking to do. It's not about the house. It's about the lifestyle that house is going to give me once I've reached my goals. And that's part of my strategy, is making sure that I set that up. And that's part of what you need to be doing too. So as you're identifying the client, you understand what their needs are, but you have to also decide whether you're going to be focusing in on cash flow or you're going to be focusing in on appreciation, because you can't necessarily get both. And I'll give you a really good example of what I mean by that. Is if you had gone out, and let's use stocks as an example. Let's say that everybody buys from Amazon. Everybody buys from Amazon. Let's just say that Amazon is the one that you bought from Amazon early on. You bought some of their stocks back when they were like $2, $3 a piece. Guess what? You would be a millionaire right now, because that was really high risk when that came out. But right now it's very low risk. It appreciated substantially. And when you first got the stocks, you were getting some significant dividends off of those stocks. Significant, because you paid very little for them and they were giving you a benefit of the proceeds. But now if you were to go buy a stock of Amazon, you'd be spending just for one stock a lot of money. I don't know what they're running right now, but let's just say it's right around $1,000 or $2,000 per stock. Now, the dividends aren't nearly as good. So you have to look at it from that perspective. It's the same concept. Cash flow, risk, appreciation, that's going to play into the model as we go in. So let's go ahead. We're going to dive in. We're going to talk about the client model in what's called the client model bell curve. And this piece right here is something that you really need to understand, and you really need to spend a little bit of time doing this. We're gonna put some meat and bones to this so we can talk about specific models and specific people who are doing these models. I'm going to share some strategies that people have used when it comes to this. So when you're getting into the bell curve, you can see right here through this bell curve that there is a leading edge, there's a center portion, and then there is a trailing edge. Each one of these is going to be with a different characteristic. Now, there's trade-offs with each one. Some of them are going to have better cash flow than others. Some are going to have more maintenance than others. Some are going to have more appreciation than others. Some are going to have a lot of turnover. So overall risk, you need to be making sure that you're picking your model to match what you're looking to accomplish with how much you're planning on managing the property and managing the small business that you've just started. So we're discussing this from a 12-month rental model. We're really not going to dive into short-term rentals. That's for another time. We'll talk a little bit about them. There is a model that does work with that. But this one is really designed for the 12-month rental model is what we're going to be discussing. Now, when it comes to the bell curve, in the leading edge of the bell curve, this is workforce housing. In workforce housing, it's likely that you're going to see a stronger cash flow, but it's also likely that you're going to have to be a little bit more involved in the process. You may have to make sure that as you're getting set up with this process, that you're really getting set up to understand that the dynamics behind how this process works with them is going to be a little different. Because if we talk about the workforce, imagine a workforce that is working in the trades. And so let's call them carpenters, let's call them plumbers, maybe plumber assistants, maybe they're techs at the pharmacy, maybe they're working as laborers in masonry. You kind of get the picture. Maybe they're working in a grocery store, stocking shelves. They're going to be more of that workforce, more of a low entry point housing. Probably price points up to about, I would say 250 to 300 would be the maximum number in that price point where you're going to get in a lot of workforce people involved in it. Now, think about it from this standpoint is that those people, when nothing wrong with that category, but they tend to have some characteristics that are extremely important. Number one of the characteristics is they don't necessarily have reliable transportation all the time, and they may need to live near some form of a transit line. They may be very sensitive to rent. If it's $25 off, that could be the difference between them eating or paying for the medications or not eating and paying for the medications. They're going to be a little less sensitive to the condition of the home. They just want something safe for and secure for their family that is not going to cost them an arm and a leg to heat, cool, and actually live in. They're also going to be necessarily looking in some spaces where they may have to move around and follow work. And so you may see a fair amount of turnover with this client group. They tend to be in that characteristic where they're going to be prepared to make moves. Now, they're also going to be in that characteristic where they're not necessarily used to maintaining a home. So you may have some extra repairs and damages that go with it. So that means that when you're looking at this type of home and you're setting it up, you want to make sure that some of your goods and your services that are coming into that specific space are going to be, designed for more of a blue collar worker who's going to be a little tougher on the house. You could get into, so here are some sections as well. There's usually section 8 in here. There's renting by the room in here. That's a model that actually can work very, very well. I actually have several clients who do rent by the room, and that works extremely well. because in each room, you now can rent each room per price, and get it set up based off of whatever that is. Like, so for example, in the case of this person, they have 4 bedrooms in the house. They have a den that they converted to another bedroom. They have a joint living room where everybody can hang out, and then they have a kitchen where everybody can share the kitchen. Now, in that, they have shared bathrooms and other things like that. The one that has the dedicated bathroom, they get to pay a little bit more. The ones who have the Jack and Jills and they have to share, then all of that changes in accordance with different things. But they're renting it out, all 4 or 5 bedrooms, they're renting them out at $800 a room. $800 a room times 5 rooms, you do the math, that's a fairly good return on investment. The challenge is if something breaks, which of the 5 of them did it? And nobody's going to say that I did it. So now you have to start thinking through the model again as far as how am I going to manage and how am I going to make each one of these pieces happen. Now, in that lower category of 300, you can actually see a fair amount of appreciation. So, for example, one of the markets that I'm working in, which is the Richmond, Virginia market, just south of Richmond, there is a location in a city called Petersburg, which is up and coming. Now, 5 years ago, Petersburg was in a massive amount of risk because it was a very difficult neighborhood. It was gentrifying, it was changing, it was upgrading, it was changing very fast. But at the same point in time, it was a very difficult neighborhood to be in. There was some crime, there were some issues, there were all sorts of other things. That would have been like buying Amazon back when it was a huge risk. Nobody knew what was happening down in Petersburg. Nobody knew what was going to happen with Amazon. It was a massive risk. Now, Petersburg is still risky. It could go very nicely or it could go very badly. Now, the chances of it going nicely are actually significantly better. But if you've noticed, 5, 6 years ago, you could buy a home in Petersburg for probably about 150, and that was considered the going rate. Now, the same home is quite a bit more than that. So home prices have appreciated quite a bit. You have to look in it as that standpoint, because if you can forecast and understand where the market is moving and you're able to buy into that market and actually turn it into something that you can, then all of a sudden the appreciation on that home is going to go up significantly. But there's risk in that. Okay. So property appreciation in this first third is very possible. It's very likely that you're going to see some significant appreciation. Now, the risk there is that it could go the other way and you don't see the appreciation. But the big news with this is that the cash flow in this leading edge tends to be much better. And the reason why the cash flow tends to be better is because you're buying the homes at a lower price and you're able to get a reasonable market rent for them. And so, strategically speaking, it's not necessarily a bad model to pick, as long as you pick the right model to house it and rent it out. And so, some of the common models that I have seen down in an area similar to that is I have actually seen a lot of renting by the room. I've also seen a lot of 12-month rentals where they rent the house out completely. And then I've also seen there's another group that, and this is not to get on any side of a political conversation, but there are groups of undocumented workers that would love to rent a room or rent an entire house. And all these pieces play specifically into this leading edge model. And so it's really a big deal to consider that and understand what it is you're getting into. Now, I had one person that I know, I'm going to call him John. He rented a house to somebody from the Mideast. They were in this category of the leading edge. The tenant gave him a third more than what he thought he should be getting for this house. He rented it out. When the tenant moved out 4 years later, he didn't manage it. So he didn't treat it like a business. He didn't manage it. It turned into an absolute disaster for him. He ended up having to wholesale the house because the tenant had done so much damage to the house. That is not a failure in the model. That is a failure in the management. And those are big pieces. Understanding if you're going to create that model, you have to create the management pieces to fall in place to go with it. Now, let's tailor on from here and let's go into the middle third. Now, this one right here is a different lane. This is more of a balanced lane. Personally, this is where I like to hang out. I'm not going to see a huge appreciation with something like this. It tends to be more stable. I'm not going to see the greatest cash flow, but I am going to see consistency. Now, when I bought my first rental, it was in this category right here. That's the one that had the $50,000 worth of damage. And the tenants that were about to move into the house at that point in time that didn't make it in, they were doctors. Now, I had planned this because we had right in the area that I was looking to buy, there are three hospitals surrounding this neighborhood. And so it was a perfect location for either a nurse or for a doctor or for a short-term physician or for something like that to come in. So I had played that card correctly. I just made a huge mistake when I had the problem with the water. I adjusted my strategy because it's also close to a university. And those people called on me and said, "Hey, we're going to give you 30% more." Now, that's where my model fell apart, and that's where my strategy fell apart. But the good news is if you set the strategy and stick with it, you'll find that you're not going to find that that's going to be a problem. For many first-time investors, stability is what matters. And that's what mattered to me when I bought my first one. And so for me, it was more of a goal of trying to sleep well at night instead of worrying about what I was going to have to do with the house. Now, let's talk about the characteristics of this middle group right here. The characteristics of these people, they tend to be semi-professional or professional people. Their work stability is pretty common. It's not usually an issue. Their margin rate of return is going to be fairly stable. The property maintenance is going to be somewhat infrequent unless you put college kids in and don't have a good monitoring system. Yeah, that was painful. You can tell it was painful. The property with the balanced cash flow in this case is you're going to see a reasonable appreciation. It's probably not going to be like Google or maybe like Petersburg, like what I'm expressing. The tenant turnover is going to be fairly stable. Now, the doctor, he probably would have been gone in a year because, I mean, a doctor doesn't need a rental. He can actually go buy his own home. But he was just out of residency and he needed a place to land until he was able to go into his next assignment. Now, this is the portion of the graph where personally I love to have this one. This is a sandbox I like to play in because in my perception of the market is that there's a little less maintenance from my perspective, having to chase people around, trying to catch up with rent, which is kind of what you may end up finding in the first segment. Not all of them are like that, but it does tend to be one of the characteristics that you will see with that. The center client third that you're seeing right here, this middle third tends to speak better to me just because of what it does for my situation. Now, you also need to help make sure that you're not looking at this with a blind spot because maybe you have a little bit more time on your hands and you can manage the other one and you feel better and your entry point, your cash flow and everything else is designed for that first segment. That's entirely fine. We can get you set up for that as well. Now, if we get into this lagging third, now you're in a higher price point. It's going to attract very predictable tenants. But you're also going to be looking at lower cash flows and much higher expectations. This lagging third is going to be somewhere near the $600,000 range, give or take. They're going to be willing to pay well, but they're also not going to be putting up with deficiencies in the property. And I'll share with you a case in point. There was a nice rental in one of those brownstone townhomes, 4-level townhomes. And that rental was a fantastic rental, but his payment was $3,000 a month. And he could get $4,000 a month in rent. Now, the home valuation on something like that was somewhere in the mid sixes, upper sixes. And $4,000 a month sounded really good when he was making a payment somewhere in the low 3,000 range, about $800, give or take. The problem is that the tenant wouldn't put up with anything. If the doorknob was not working correctly, they wanted it fixed. If the sink drain was not draining correctly, they wanted it fixed. If there was a loose hinge, they wanted that fixed. and they were getting calls all the time to be able to get that stuff fixed and done. And also, if the previous tenants left a stain in one of the carpets, just shampooing the carpet wasn't enough for them. They wanted the carpet replaced. And that's some of the problems that you might deal with in that is that you're going to have a much lower rate of return, but you're going to have a very predictable tenant. They're going to have work stability. Many of them are going to be there for short-term assignments, maybe doctors, therapists, pilots, different things like that, but they're not going to tolerate imperfections with it. And then they're going to also, you might see property appreciation growing, but your cash flow could be a little lower. And then your tenant turnover might be a little higher because most of these people are there for temporary assignments and they may not necessarily be there for very long term, 1 year, maybe 2 years at the most, and they can easily be relocated again. So it's really important for you to kind of look through these pieces and make sure that you understand how that gets set up. Now, I'm going to provide you with a little gift after we're done today. I'm going to send, I have this available. If you'd like me to send it to you, this is free. I'd be happy to send this to you so you can get it set up. I put a little criteria as far as different parts and pieces of what to look at when you're looking at the client model, because this is going to be really important. As you're determining what you're getting set up, we want to stop looking at the home emotionally and looking at it like a strong investment. What is strong? What is weak? What is the opportunity? And what exists nearby that could make the ownership harder? And what you're seeing right here is the beginnings of what's called a SWOT. A SWOT is an analysis that's used. It's called the strengths, weaknesses, opportunities, and threats. And so the acronym SWOT, S-W-O-T, that's what it stands for. It's a really good idea to do a SWOT analysis on the home so that you can understand what you're getting into with each one of these. And this right here helps you kind of think through how you're going to get that. And then identify what the features are that you like in conjunction with the clients that you're looking for. If you're looking for a single family versus multifamily, that's another one. Multifamily is another great aspect of doing this. The great thing with multifamily is cash flow. The downside to multifamily is they don't tend to appreciate as quickly. But cash flow, they're super good when you get into cash flow. But if you're looking for cash flow, like I am actually looking for duplexes, triplexes, and quads, because in my model, I'm looking for that down the road. I'm looking to make sure that I have the cash flow going into retirement. That's a really good model for me. And I can manage one location better than I can manage a bunch of different locations all over the place. And so you just have to look at that, because that moderate appreciation with something like that is not necessarily a factor for me. It's more going to be about the cash flow. Now, you also have other things that are available, which are townhomes and condos. Just make sure that if you're looking at that, that you know what the HOA costs are, and you know whether you can defer those by passing those on to the tenant or not passing them on to the tenant. Basically, what you're really looking to understand is understand the strengths of your system and identify what it is that you want to buy so that your client can really get set up for being a long-term, consistent client who takes well care of the house, and then understand what the weaknesses are, what your opportunities are with this, and then, of course, the threats. There are several threats, several different states that I am have more tenant-friendly laws than other states. And so you have to kind of consider which one makes the most sense because of those different characteristics. You really need to look at it all to understand it. Okay. Now, the reason why all this matters is I'm just going to share a real quick behind the scenes on me as to why this matters and why I'm doing this, because there's not very many people who are going through this type of scenario to help you understand how an investment home will work and how you can get set up for success in buying one of these homes. You see, when I grew up very blue collar, which is a great way of saying that we were poor. But like many families, my family found themselves, they were carrying too much debt. They had a hard time making decisions, and when they did, they weren't always the best ones. And so along the way, we had to learn a lesson. We had to learn a lesson of how to create cash flow and how to create choices that were different than what got us in there. Because we realized very quickly that we did not understand cash flow and we did not understand financial institutions and they didn't understand us. But cash flow, we saw from other people, we did understand the repercussions of not having cash flow. And we did understand that cash flow gives you a greater opportunity to create new choices. So my parents decided to work very hard and they started paying off all the debt that they had. They then created some liquidity. They turned around and then bought the home. They accelerated their payments and they paid it off. They continued and they bought another home. Then they bought some additional properties. Not flashy, not fast. It was just a steady plan built over time. Now, the reason why this is important and why it matters is my dad passed away last fall, and my mom is in her mid 80s, and she lives completely independently because of exactly what we're talking about, because of cash flow. That independence didn't happen by accident. It was built through years of decisions, years of bad decisions, and then years of good decisions. And that story shaped how I see mortgages. It shaped how I see real estate. And I realized that the mortgage is never the goal. The property is never the goal. The goal is what those tools will help you do and create, and the security that you'll get from those choices. Because now you can create more confidence and a better future when it's all said today. So today, I'm helping families and investors make those great decisions and trying to make sure that we're setting you up for success. I have all sorts of business reasons as to why, but the main one is that we're really desiring to serve families and help them make good decisions long after they bought the home. We want to make sure that you can see with transparency how to do it, that you know how to do it, and we can guide you with it. And then you can trust us because we're showing you exactly how it can make your life better. Not always the cheapest, but hey, cheapest doesn't always make the most sense. And and this is where we get into the financial model, because I see investors many times chasing the cheapest and miss the larger strategy. And strategy, when it comes to owning a rental, owning your own small business, you need to have the right structure and you need to have the right strategy. Otherwise, it's going to drain your reserves. It's going to hurt you for the next purchase. It's going to put you into the wrong loan. You're going to create the wrong structure. And literally, that doesn't help. Sometimes I see people go for the lowest quote, and that's fine. But rates, fees, payments, those parts are the parts that are important, yes. But what's even more important is make sure that your cash is preserved, that your reserves are protected, that your rental income is ruling what's happening so that you're not risking future purchases. And believe it or not, you also need an exit strategy. You need to see and understand how to get out of this home should things not go well. And I see investors make mistakes all the time. They spend all their energy trying to save a few dollars on the mortgage, but then they miss the bigger issues. And then later on, they're in all sorts of pickles making that happen. And I'm not here to win a rate shopping contest. I'm really here to help you structure your investment so that your property and your financing, your reserves, and everything plays together. So having said that, let's get into the financial model right now. And right here, when we get into this, you are now the operator of this business, and you need to understand what it's going to take to help you get in there. And when you need the operator, you need to make sure that you have these mechanisms, these models under control, because real cash flow is not what you're getting every month. The real cash flow is what you have after vacancy, after repairs, after turnovers, after maintenance, after management, and any kind of reserves and surprises that you might get. And so to make sure that we get you set up for success, we need to make sure that we're getting you set up to understand not only how to qualify, but how to create the cash flow, how to create the taxable advantage, and then also what that depreciation means for you in appreciation cycle. So first of all, there are several different models that you can use to buy to buy an investment home. The most common one is going to be the traditional for the long-term rental models, but there are other occupancy models that you can use with this. A 12-month rental model tends to be really good. I do another workshop on buying second homes, and many times in the second home model, we talk about how to deal with short-term rentals and flexible rental models. Those are actually very good ones. And then the shared occupancy model, we've talked about a little bit there as well. These are going to be strategy driven. You need to really kind of look at how you're going to be setting this up so that you can make sure that you're setting this up for long term. Now, when it comes to buying the house, it's very simple. You're going to have to put a down payment down on the house. Usually it's between 15% and higher. Terms get a lot better if you can put 20 or 25% or more. That's actually really important when it comes to this. So when you're getting into the down payment, these are the pieces that you need to be looking at with a financial model. Can you come up with this? The 15 to 20 to 25% down. And if you're doing multifamily, you have to put 25% down. I don't want to belabor this a ton, but strategically speaking, you just want to make sure that you have enough money to cover the down payment, the legal fees for the settlement, and that you have reserves, because we want to make sure that you're not completely destitute after you bought this home. You can't get any gifts. So whoever's on the loan, that's the way that you are buying this house. Whoever's on the loan can be buying it. Now, there are models where you can get multiple people on the loan. There are models where you can buy them under an LLC. The traditional method of buying is not under an LLC. It's under this model right here, which is just a traditional financing. You can't get any gifts, so whoever's on the loan has to be on there. And we can use the projected rent to offset the mortgage for the first year. So this is a great thing to do. So if you're buying a home that you're going to be converting to a rental, and that home is going to produce $2,500 in rental income, and you're only going to have a payment of $2,000 per month, it completely offsets the monthly payment for that home. And you really just need to come up with a down payment to go with it. You can even ask the seller to cover 2% cost. It really does help you get set up with this for success. So the financial model, that's very traditional. And if you go into alternative financing, you can certainly do that with bank statement loans or profit loss loans, or even a DSCR loan, which is not really a conversation for your first home. For your first investment home, that's a conversation for maybe down the road when you've been a little bit more seasoned and you're doing some more of these like that. Now, where can you get the money from? There are several ways to get cash. You can pull from a 401k. You can actually do a self-directed IRA as well. I actually had a client who got done with one of these workshops, and they went and they found out that they could transfer their 401k into a self-directed IRA. And so they transferred it over there, and then they used that in order to be able to take the money out of the 401k, or the IRA in this case, and then go ahead and use it to purchase. They had quite a substantial amount. Now, with this, what you need to be aware of is that there are quite a few rules. It's not as simple as just taking your 401k, rolling it into self-directed IRA. There's a lot of rules that come with that, because every penny that you get from rent has to go back into that IRA unless there are costs associated with it. Now, you can take distributions from the IRA in order to make up for maintenance and other things like that. So it is a good model when it works that, but just remember that you're not making cash flow on it initially if you go through the self-directed route. But if you do take money out of your 401k through a hardship distribution, or not through a hardship, but just through a distribution, you can certainly do that. I've also seen people do that from their Roth IRAs. It actually works very well with that as well. You can also go and take a home equity line of credit. That's what the HELOC stands for. Home equity line of credit is a good way to get money out of your house to do that. I've done that twice so far in the last 60 days. It works very well. And because the HELOC is attached to your primary home, you have to check the tax laws, but in some places that interest that you will be paying on the HELOC, because it's attached to your primary, is tax deductible. But that is something that you need to talk to your CPA about, because there are some changes coming with that. The DSCR loan, that's a different one. That is not a first-time investor kind of program, but we'll talk about it real quick. DSCR, in essence, is if the rent covers the payment, you can buy the house. So in other words, we're not going to look at income anymore. We're not looking at your entire package, like as far as a loan package, like we would with traditional lending. We're only going to be looking to see if the monthly payment covers it. And if it does, then it works beautifully. The collateralized assets or equities is if you have stocks and you want to take it out. Like, for example, Morgan Stanley has an opportunity to where you could collateralize your assets. In other words, sign them over to them in case you don't repay them, and they'll give you a short-term loan so that you can use it to buy the house. These are all ways that you can do it, and it does work. Most people, I would say, they have it in savings. They take it from a 401k, or they cash in some stocks, or they'll go the self-directed IRA or the HELOC method. Those are the most common ways of getting the money necessary for the down payment. Okay. Now, in the financial model, there are also some benefits that you get when it comes to taxation. And so with the benefits that come with taxation, you just need to be aware that these are fantastic ways to get set up to improve your cash flow later. The passive income is really good because you're getting passive unless you're a real estate agent and you do this 100% of the time, which a lot of people, once they have 10 or more rentals, they can convert that into a business model from the IRS standpoint. And then now you can write off time and other things like that. But in the passive model, and so you can see the active model and the passive model right there. And the active model, you have to have 100 hours and it has to be part of an LLC and other things like that. But in the passive model, which is the passive model that I have, then I'm going to be able to take depreciation. I can actually do cost segregation. Cost segregation is very important. If you have like appliances that were expensive that you had to do something with, you can cost segregate those and write those off automatically. Now, there's a basic difference between the passive model and the active model. In the passive model, the reason why I like the passive model is because my goal is to live that out through my retirement years and then pass that property on to my children later. If I do it through the passive model, my kids do not pay taxes on what's called the step-up basis, which means if I bought the home at 250, now it's worth 500, you would pay capital gains on that $250,000 difference if you were in the active income model. Whereas in the passive income model, you don't. The kids inherit it at that 500. They don't pay taxes on that 500. They can now sell it and they can get a full distribution based off of that. Certainly talk to your CPA or tax person so that they can help set you up for that. Now, in the cash flow analysis, this is actually really important to help you understand, because when you're starting to go identify the house, now you need to identify how much rent it is that you can pull. And hope in this case is not a good strategy. We need the data. You need to make sure that you know what the market can support and what does competition look like for realistic rent. The market has to support the story. And so when you're going and looking at these properties, you need to make sure that you're looking at these properties with a very critical eye. Understanding how much it's going to cost to maintain it, cost for all these other pieces, make the payments, everything else. But if your rent doesn't cover something and you don't have some reserves afterwards, you're really getting yourself set up for all sorts of trouble. So you really need to understand what that rental model can generate when it comes to rent or the income that you're going to be receiving. So here's a couple simple ways. I actually used Zillow.com, but you can pay for Rentometer if you'd like to, or you can pay for Bigger Pockets. Those are all possible places you can go. Realtor.com and Zillow, you will find that they have buttons on there that you can actually push, and you can convert it from a home that is for sale to a home that is for rent. And if you zero in on the geography of the area that you're looking at, you'll get to see what rentals are in the neighborhood around it and how much those are being rented for. So it's worth your time to make sure that you can go in and you can see how those are being set up and make sure that you can compare the home, do a really deep analysis of the home to make sure that you're getting set up for success. Because you have to look at the saturation point. Are there too many rentals? Does my business model make that work? Is a return on investment there? Is there enough cash flow? Does the data actually support this? And then next, but most importantly, in the cash flow analysis and the depreciation analysis and also the appreciation analysis, does it cover everything that I'm looking to accomplish with this home? Because if it doesn't, and you haven't done your analysis completely on this, you can actually set yourself up for disaster. Now I'm gonna share with you a really good resource that can help you think through this, and you'll actually see this worksheet inside this book. Now, I personally bought this book for $3. I bought it for $3 in the used section on Amazon. I would encourage you, if you're really looking to get into real estate investing, I would really encourage you to go ahead and buy this book. It is written by Gary Keller. It's a fantastic book. It is meat and potatoes when it comes to this. This is where emotion meets the math. The property may feel exciting, but the spreadsheet tells us whether the excitement is earned. You have to go through the spreadsheet. And this sheet is extremely important when it comes to this. Now, I have some copies of it because here's what you need to know with this is this property needs to work even when life happens. What if property sits vacant for a while? What if you got repairs? What if you got insurance and taxes? The bottom line is hope is not a strategy, and you need to make sure that your reserves are the strategy. And what it sounds like and what it looks like is that my first rental taught me the hard way that I had to make sure that I had to get these things set up and understood. Not only the 2 inches of water, but the lesson I learned through these college kids. And it's not that I couldn't have made the college kids work. I just was not prepared for the business model associated with college kids. I just wasn't prepared for it. If I had had a business model in mind that worked for college kids and I knew from beginning to end how to protect the situation, I would have probably been very successful in it and I would still be renting to college kids. But I did not have it. And so I have decided that my business model needs to stick with my original plan. I have it near the doctors and in the town, and that's going to be where it ends up getting rented. So it's a really good idea to make sure you have it. Now, I do have a spreadsheet, more than happy to share this with you later if you would like it, on how to calculate income and how to make sure that you're getting set up for total reserves when it comes to this. Because it's really important to make sure that you know what you're getting into. And this spreadsheet that you're seeing right here was actually taken directly from that book that you have right there. More than happy to share it. I saw your note, Amanda. I'll make sure you get it. Okay. This is taken from the book that I just shared with you. And so this spreadsheet right here works very well. It tells you right here the cash on return on investment. It tells you the first year return on investment. And if these numbers don't work for you, you need to make sure that you're looking at it very carefully because it may not necessarily, this house may not be one that works for you. So if you're going to win, you need to make sure that you rent for cash flow because that's what pays the bills. Appreciation's good, but cash flow is what pays the bills. Okay. And you need to be making sure that you look at these numbers and that you win going in. So let's just review this real quick. Make sure that you get in, make sure that you have the right perspective as an investor, make sure that you know what you're looking to do as far as investment when it comes to the different properties. Make sure that you know the rate and what you bought it for, what repairs are needed, and what's negotiated. All that plays into this. So you can see right here in this case, you can buy, in this case, this one's a duplex. You can see unit A is going to get 1,400, unit B is going to get 1,400. That's my annual. That's my net rental. That's my total over the year. This is what my payment is with the HOAs. If there is one, here's the length of the rental. I bought some points. Here's my escrows, my closing costs. All that stuff is in there. Now I've got some information that I can play with when it comes to that. And then coming down to the bottom, the appreciation rate is included in there based off of different things. So it's worth looking at, worth understanding. All right, so now we get into the next piece, which is actually if you're going to win, it's not only how you buy it, but it's also how you finance it. And it's also the last piece, how are you going to manage it? Because buying the property is the fun part. The hard part is the managing. Buying the property is just the beginning, but your return is based off of how well you manage it. And so consistent returns are all in about management. You have to decide whether you're going to self-manage or whether you're going to get a professional manager. Now, I just did a YouTube video with a podcast last week that we posted where we had a pretty good debate going about self-management versus professional management. And that, I'm going to tell you, is a really good question, because for the first-time investor, you don't know what you don't know. And you have to kind of decide which one makes the most sense. Because professionally managed, they're going to take about 10% of your fees. Okay. Well, that's a lot of money. If you're only making $750 on the rental and they're taking 250 of it, you're only making $500. And that has to make sure that you're taking care of contracts, because they're not handling the maintenance for you. They're just going to say, I called the plumber, he's going over. Okay. You're still paying for it. They're just doing that to manage the tenant, to manage the phone calls, to manage all the collections, to manage the maintenance requests, the tenant communications, the turnover inspections, and the network of vendors, which, by the way, this is where your money is made. I'm going to let you know, having almost had to take those kids to court, that I did not have the paperwork in place to understand how this worked. And this right here is where your money is made, in the contracts, in the point of sale and the payment, in how you're going to collect it, how you're going to manage maintenance requests, tenant communications. Because if it's over the phone, is there a legal record of it? That's a big one. Tenant turnovers, turnover inspections. That's a big one. And then also your network of vendors. These are all extremely important to make this happen, because the difference between 8 and 10% and knowing what you're doing is pretty important, but it also reduces some of your headaches. And maybe it's worth your time to do something like this. Now, here's what you need to understand when you get into this is getting set up. You can get professionally managed and get real estate agents to do it. You can get online entities. There are some tools that you can use that are online. You can find those fairly easily. Some of these, I think, are, since I just published this, are out of business now. I don't think Buildium and Tenant Turner are still around. But anyway, the one that I use is actually this one right here. I use Zillow Rental Manager and apartments.com. Zillow Rental Manager is fantastic for helping you market the property to the next tenants. And this is actually pretty important for you to see, because Turbo Tenant, okay, you use Turbo Tenant. So that one's good. So I use Zillow Rental Manager because it's free. It's free up to 10, and it has a really good way. It's the most widely accepted way of marketing it. And then I actually use apartments.com to collect, because that has a great communication platform, a great document storage platform. It's also free, and it has a great payment platform. Now, you need to know that if you're expecting them to pay on the first of the month, and your payment to the mortgage company is on the first of the month, and they pay on the first of the month, you're not getting your cash on the first of the month. That's why reserves are important, because it takes 3 to 4 days to get it through the system and into your bank account. So just keep that in mind if you're using any one of those rental managers to do something like this. And I've used the simple systems. They're usually pretty good. I would encourage you to find one that's super simple, that can help you casually turn your management into a strong point, because this is really where the money is made. Okay. The reason I like the Zillow one is it'll do, when they put an application in to come do it, it'll actually force them to get a credit report one, which then they'll send it to me. It all works extremely well. I really like it.
Hey, can I bring something up?
Yeah.
So I use Zillow for procurement, and it just works great for that first. So, like you said, the applications and stuff. But I have actually found, now that I have access to Forewarn, that Zillow is not pulling all like background check information. So
Okay. Well, that's good news.
actually had a convicted armed bank robber living in one of my houses.
Oh,
And it didn't pull on his Zillow stuff at all.
interesting.
So yeah,
Yeah, I think
just heads up.
Zillow focuses mainly on evictions, is what they're doing.
Yeah,
That's actually really good information and
yeah.
worth sharing. I'm glad you shared that. All right. All right. So we're wrapping it up tonight. We're getting to the last little pieces of this. And background checks are important, people. Very important, no doubt about that. And so, Amanda, thank you for sharing that. As far as building wealth through real estate, it's unmistakable that it can happen. There's all sorts of tax incentives, there's extra income, leveraging of funds. Actually, I read an article just this last week where um, Warren Buffett said that the best hedge against inflation, the best short against inflation is real estate. And he's right. Because once you've locked in that purchase price, it's not going anywhere. It's not going anywhere. All you have to do is make sure that you maintain it and that you actually keep it in pretty good shape and you manage it well. And that equity and appreciation is extremely well. For many Americans, this real estate has become the path to long-term wealth, but it's not built by accident. It's built through discipline, and it has to be through cash flow, patience, good decisions, and over time. So this is not a get rich quick, but it certainly does help diversify your portfolio when it comes to this. So when it comes to actually making this work, we've put together the 5 steps to win, and this is how we typically help clients get set up. Application is a safety point. It really gets help. It really helps you get set up to win for us to know exactly what it is that you're dealing with. The documents help us establish your position and what's going on. So understanding your payroll and different things like that and what you're paying on getting paid with W-2s, pay stubs, stuff like that is extremely important. Once we're done with that, we set the strategy. We meet with you, we go through the strategy, we try to understand, we set you up for success so that you can help and do that. And then we organize you to win. And by doing that, we pre-underwrite the loan to help you get going. We help you negotiate with the loan. And then we hope that you have many years of wonderful experiences with your new home because it's never about the mortgage. It's about the life after the mortgage. Now, if you want to follow us on YouTube, this is where this is going to land as soon as we're done. You're certainly welcome to scan it. You can look up Life After the Mortgage. That's the name of the YouTube channel. Certainly love to have you come and join in the conversation and be a part of it with us. The whole reason I do this is I'm working very differently than most people, most loan officers. You can see I've dedicated about an hour of time right now to helping you kind of gather the information on how to be successful in buying real estate. It's because I work primarily by referral. I don't want to cold call. I don't want to buy leads. I want to earn trust by giving you what you need when you need it. I'm not the cheapest guy, but I am very thoughtful. I'm also not the most expensive. I don't want to make it sound like I'm the most expensive out there, but I'm devoted to you before, during, and after. And the only thing we ask is that when you're done with the transaction with us, that you refer somebody comparable to yourself. That's it. It's a real simple strategy that is, built on earned trust, and that's really what we're trying to do. Now, this next QR code that I'm going to show you right here is actually a link to the Google Docs that has that information that you were asking for, Amanda. So I would encourage you to shoot that, go to that Google Docs section and download it. There's several different pieces in there that you can certainly take advantage of, and you don't have to figure this out alone. This is a free resource that I'm setting up for you, but you don't have to figure it out alone. Our goal is to, give you the tools, help you answer the questions, and set you up so that you can evaluate opportunities with more confidence. And we really want to be, your resource when it comes to buying your investment home, your primary home, or second home. Anything we can do to serve and help you be successful, we would certainly love the opportunity to do that and help you get set up for success. So as we wrap up tonight, if this stirred something in you and you'd like to talk more about next steps, we would love the opportunity to do that. All my contact information is right here. I'd love to set a time. Please text me, please call me, whatever you'd like to do. If you're a realtor who attended this and you'd like to co-present this to your clients, I'd be more than happy to do that. Because in essence, your money's not the dream, the property is not the dream. The dream is the life that the cash flow and the ownership and the wise decisions can help create. And that's part of what I'm trying to do here tonight is share that information with you so that you can make some great decisions and that you can build the life that you're really looking to have long after the resource has been purchased. Thank you for coming. You're certainly welcome to stick around and ask some questions if you'd like to. Otherwise, we will be done for tonight. So thank you so much.
Thanks, Chris.
Yeah,
Hey, I just ordered that book on Amazon. Have you read the Flip one?
I have started it. I